David, welcome to the channel. It's been, I know, a year since we've last talked here on the podcast. I just wanted to kind of welcome you back.
Thanks, Dimitri. Happy to be here.
So let's just start off with, so those of you that don't know you, right? You're teaching at NYU. You're valuations expert. It's how I describe you. Everyone's like, who's David Shimko? I'm like, oh, he's this guy in valuations, and I get really excited. Um, but so you're teaching. Let's just start with that. I guess NYU, you're still teaching valuations, a class there. Is it just one class that you're teaching as part of the NYU Tandon quantitative finance masters there?
Yeah, it's actually, well, more than one class. It's a core class, so everyone has to take it except if they have like three classes in valuation or finance before they come to the program. So almost everyone takes it.
Okay.
So I have four sections I'm teaching this fall, and it's really intense. It's one of those classes that can be a lot of fun, but also a lot of work. So my favorite thing is when students say at the end of the term it was their favorite class, but also the one they work the hardest for.
I think that's a good balance. That's
Yeah.
not like you were my favorite class because it was the easy, just coasted through, but at least you're learning something. It's a rigorous class at the same time.
Yeah, exactly right. Perfect description.
So what do you guys cover in your valuations class? When I took my master's, I never took valuations. A lot of other students took it and they raved about it. It was like eye-opening, different perspective. It really helped them, even now talking to them with their careers. I mean,
Yeah.
what are kind of the core concepts that you cover through your valuations course?
When you think of a typical MBA or PhD program, you have different classes, right, for valuing equities or fixed income or derivatives,
Hmm.
right?
Yeah.
And you almost think, well, there's even different discounting conventions. These are all completely different markets. I need to, devote a separate part of my brain to each one of these activities. Where the approach that I take is to say, well, they're actually every evaluation is a special case of a general scheme, right? For example, today I'm teaching my very first class for the season, for the academic year, and we're talking about something I call the general valuation equation, which
Okay.
is something that applies to valuing, simple cash flows like perpetuities, but can also value things like stocks or bonds or futures or options. And it doesn't matter whether it's discrete time or continuous time. In each case, there's a single differential equation, right, that describes how to value all of these things.
Okay.
So the purpose of the class is to give students the valuation tools to be able to see valuation in a general way. This way, when they're thrown something that's different, they know how to handle it. So let's say, for example, week three of the class, I do CDOs. I think I mentioned this on their last broadcast, actually. Uh, but week three, we do CDOs, and students freak out. Like, I don't know what a CDO is. I'm a computer science major. you know, and they come to the class. And once you explain to them that, well, here's the cash flows that are generated by this instrument, and now your job is to value these cash flows. Here's the cash flows. You can simulate the risks and so on. How do you value this? Why is that different than any other asset that creates cash flows and risks? So once they see that, they say, oh, okay, so then all I need to do is to develop tools to be efficient, to be able to evaluate anything you throw my way.
Okay.
So in addition, now, the other criticism I have of traditional finance teaching is it's kind of built on a foundation of thinking about large project, large companies, competitive markets, or if not perfect, close to perfect markets, and all the theory we've developed around those things. What happens when you introduce an imperfection in that market?
Hmm.
Okay, so I'll give you a great example, which I call the Elon Musk problem.
All right.
All right, so you get to pretend you're Elon Musk for a minute, and here's the deal: I'm going to give you $10 if you accept the deal. I'll give you $10, and then we're going to toss a coin. If it ends up heads, you're going to pay me, I don't know, $20 billion.
Okay.
And if it goes the other way, then I'll pay you 20 billion. Okay. So it's going to happen right now. There's no time value to consider. What is the value of that deal?
I mean, I would assume zero.
Well, that means that you're willing to take it.
Yeah. Yeah. Yeah.
You willing to take it?
Yeah, I'd be willing to take it.
You Elon Musk, you're gonna bet everything on the coin toss of one?
Maybe, maybe not.
Okay.
I feel like there's risk in there too that we're not considering, right?
Yeah, I think you might reconsider with time. Maybe you'll sit up late at night tonight and say, "Oh my God, I shouldn't have taken that deal."
Yeah.
But the idea is if we were at J.P. Morgan in the day and someone proposed such a deal, which obviously this is a very abstracted version of it, where we could have either make a lot or lose a lot, we would charge them a risk charge for that, right?
Mm-hmm.
You'd say, well, okay, if it's $20 billion, you're gonna have to pay us 5 billion just to take the deal. And
Okay.
then we'll think about it, right? And even then we might not do it,
Yeah.
right? Because of the concentration of risk in our portfolios, we have to syndicate it or something like this. So it's obvious to me anyway that the value of that deal should be negative. To Elon Musk, it should be off negative to me who's offering the deal as well.
Okay.
Now, you
Yeah.
said zero because if you think about discounting, you calculate the expected value was $10,
Yep.
right? You discount it at whatever rate of interest you choose. Doesn't matter what interest rate you use because you cannot get a number below zero.
Yeah. Yeah.
So how do you live in a world, right, where you can't get a negative valuation? And this is exactly what I encountered in my consulting practice is energy companies that were going after these power supply contracts realized they're not protected by limited liability,
Mm-hmm.
right? Power price can do this, the gas price can do this, and the prices can become negative. The
Yeah.
expected value can be positive, and the value can still be negative.
Okay. Yeah.
You can't get there in a present value model.
Yeah.
There's no discount rate you can use to get to that negative valuation, right?
Yeah. Yeah. Because you've got cash coming in and you're discounting it back.
So this is something I'll deal with on the first day of class. How do you accept a model like the CAPM, right? Which assumes that risk is proportional to the value of something. And what that implies, and you don't realize this, if the risk is proportional to the value of the asset always,
Mm-hmm.
whenever the value of the asset drops, the risk drops.
Okay.
That's not the case in the real world. So
Yeah.
if you're going to talk about valuation, first of all, we got to throw away the CAPM, right? Or at least adapt it to figure out how do we deal with cash flows where the expected value is positive, but the risk is so great that the actual value is negative.
Okay. So I mean, you're really breaking away then from the traditional financial, I guess,
Yeah.
train of thought.
And doing it this way means we can open it up to valuing anything. We can value private deals. We can value VC deals with constrained capital. We can value even the simplest cash flows. Another example I give my students is to say, well, if the federal government promises me $1 million in 50 years, and let's say that we have a 50-year benchmark discount rate of 5%, what's the value of that deal to me? And the answer is, well, you'd say, all right, find the present value of 50 million at 5%. That's the value of the deal to you. I said, no, it's not. I don't want that deal. First of all, I'm not going to be around in 50 years, and even some of my children won't even be around, right? But all kidding aside, there's lots of reasons why I wouldn't take that deal. If I could get a 6% return on my money, for example, for 50 years, why would I touch a deal where I'm making 5%? How can that be the value of the deal? Right? So present value is so limited, and people don't realize the limitations when they go into this kind of modeling. So the idea of valuation writ large is to say, okay, if someone's going to throw a real option at you, or someone's going to have a non-marketable security, right, or a contract that can have negative valuations, you got to be able to value those things.
Yeah. Are you able to put in the opportunity cost?
Yeah, it's a risk charge basically.
Okay.
Well, but in the key is in the CAPM, the risk charge is always assumed to be proportional to the asset value. And that's why you get this sort of positivity in the value when you have positive expected cash flows. But with a risk charge in dollars, you can cause the expected value risk adjusted to become negative, which is really the trick.
Okay.
So one thing is we get it completely away from percentages and measure everything in currency terms.
Okay. I guess that makes sense. It's a better way to kind of do it. I know even when we do analysis at work, we do it in dollars.
Yeah.
I want to see the dollar value on this. The business understands the dollars. As soon as we get into percentages and we start to ask the question, so like, 8% of what? Like, what is that
Well,
expected?
yeah, that's a problem. How do you calculate the return on a futures contract? I asked my advisor in graduate school. You know, you can calculate the P&L, but since your investment is zero theoretically, even though
Yeah.
you put up a margin, I mean, do you use the margin to calculate the return? No, because you could lose more than the margin, right? You're not going to lose an infinite amount for sure. No one's ever done that before. So how do you calculate the expected return? So now if you're going to do financial analysis with futures or with options or with even short positions in stock, which have an infinite possible loss, you can't calculate percentage returns, and therefore you have no theory to value those things. So even asset allocation, I do in dollars, not in percentages.
Do you think more of the traditional finance programs should start adapting this?
Absolutely.
I feel like there's two camps, like especially when you're on the internet. You've got the diehard, all the financial equations we know, they have to be right. We can't deviate from, CAPM or simple time value of money calculations or anything like that. And then on the other side, I feel like we have those that are way out on the side. I mean, I've seen posts that are like CAPM's wrong, and I'm like, okay, let make your point. And then it's like, it's just like name calling of it. It's horrible. It doesn't work. We threw it all out the window. And I'm just scratching my head like, there's got to be that middle ground. And I feel like this is what you're pitching here is like, okay, this is the original idea. This is exactly why it's wrong. And then how do we adapt to a better framework without, abandoning everything we know?
And you'll be shocked to learn that you know, this actually existed before the CAPM.
Okay. I didn't know that.
Before the CAPM as we know it is created by William Sharpe. And this is Lintner's version of the CAPM. Both Sharpe and Lintner shared the Nobel Prize for the CAPM, but Lintner did a cash version and Sharpe did a percent version. But
Okay.
Sharpe made a critical, it's not an error, but a critical assumption, let's call it. He assumed that once you have the expected returns and standard deviations in correlation with the assets, those were then assumed to be constant, so you can go on to calculate the optimal portfolios, which is fine, right? But then he concludes that the idiosyncratic risk has no price,
Yeah.
right? But guess what? That's false.
Yeah.
So idiosyncratic risk has a price, but it's buried because he made the assumption the expected returns are constant and known. So the risk premium for idiosyncratic risk is buried in the expected return. So this is a real valuation course. We sort of tear the blankets off the CAPM. We don't throw it away, right? But we dress it up,
Yeah.
again, to come up with a model which has its own flaws, to be sure. But the point is it's a superset of the CAPM. CAPM is a special case where the volatility is assumed to be proportional to the value of the asset, and the parameters are assumed to be constant.
Okay. Do you think we need more of those generalized equations? I always love math when it's like they tell you like, there's the discovery and then they find like the generalized equation. I feel like in many ways you're following that suit, which is like,
But it's not really like, I hate these papers that have like super mathematical equations.
yeah,
Like physicists, they write, A equals B and say, this is genius, Say, okay, how do I implement this? I don't have any idea. So, you gotta say, I have to get, I don't know, I have to show the value of my increased mathematical burden, right?
okay, yeah,
But the burden is not that great because I've always strived in my own research to make sure that all the work can be done with the mathematics that one would learn in college.
okay,
So I published a paper in Journal Derivatives a couple of summers ago, which showed that you could actually derive Black-Scholes without stochastic calculus,
mhm,
without differential equations, right? You can derive it using algebra and calculus, as long as you make a no arbitrage condition. And by the way, when I say CAPM, it's not the continuous CAPM of Merton, which was shown by Black, right? He could derive the option pricing formula. It's the one period CAPM model, which academics said you couldn't use to value options. And I proved that you actually could. You just had to reinterpret the no arbitrage condition to be a static hedge rather than a dynamic hedge.
okay. I know we talked about that a little bit last time. I'll definitely link the paper below. I'm
Yeah.
I've deviated into pure modeling in like the math world, and now working at a startup and a fintech. It's like I'm coming back full circle to these points of like, how do we make this simple and how do we actually implement it?
Great. Yeah. It's harder than it seems.
Yeah, definitely. So how do you come up with these ideas? Like what drives you to think about these problems from a different like perspective? I mean, are you like literally thinking in your head, how do I take the Black-Scholes and simplify that down into something even easier? Or do you, I mean, is
Yep.
it just kind of like a project where a project comes up, you start working on that project that sparks new ideas? Like what really drives you to kind of work on these?
I think having experience on Wall Street and consulting, you're used to solving problems that you have no perspective on at all because they're just thrown at you, and you run into a barrier. So when, energy company came to me and said, look, our valuations are all screwed up because the bids on these, gas, power and gas deals should be negative. And we can't make the models do that. How do we do that? You could say that we'll separate the revenues from the expenses, do them separately and take the difference. No, because there's interactions between them.
Yeah.
These aren't uncorrelated variables where you can make that assumption. So here's the problem. Here's a big problem. How do you solve that? How do you solve a valuation problem where cash flows are correlated with each other over time and across space? So
Yeah.
that was the problem.
Okay.
So that's a big problem to be given, and such a, I don't know, a luxury to be able to be in a position to get that problem. On the other side, with the recent project I told you about, the option pricing, it was more like, okay, I'm teaching my students this Lintner-based CAPM, which is cash flow based, and they get along with it pretty well. Some algebra, some matrix algebra, but the very straightforward solution, very intuitive, corresponds to aspects of the sharp CAPM. But as they say, okay, then you go to regular options, and suddenly it seems very complicated for students. And this is their first semester, they take valuation. So they haven't done the stochastic calculus quant methods thing fully,
Yeah.
right? I said, how can I find a way to teach this better? So now instead of my inspiration coming from, the projects I was thrown at JP Morgan or on, consulting projects, now they're being thrown by some students as well.
Okay.
So
Yeah.
how can I make this fit? And the more time I spend on it, the more problems I uncover, and the longer my textbook is getting as a result. It's been like in production for 3 years. I can't get anywhere on it because I always have to add a new chapter.
I understand that. I had the idea of doing a video series. I was like, all right, I'm going to teach a class like a professor, and I'm going to put it in so many lessons. And to your point, I started doing like these are the base ideas, and I'm like, no, 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 no. They need this other insight, and then I'd make another lesson and another lesson, and eventually I just gave up. I was like, this is.
Yeah, you can't do it. No. I truly respect those people who can write textbooks. I mean, it really is amazing. A well done textbook is a beautiful thing.
I agree, and I think there are very few of them. Some of them I read, and it's like Gilbert Strang's linear algebra book.
Oh yeah, yeah,
I
that's a
love
good
it.
one.
I
Yeah,
love the book. I don't even go through it from like an industry perspective, but it's like as you read the book and he just writes, I think more like a commentary. I feel like he's like just standing like in front of me, like teaching me, like, okay, you don't need to get too complicated. And then he explains like the simplicities and things. And I think when we find a textbook like those ones, you get really excited. Whereas I think some textbooks are great books, but the complexity is so high and you're trying to decipher. I mean, I'm working through a reinforcement learning book right now, and it's just so jargony and there's lots of math equations. And so it's like, it takes me months and months to get through it because I'm writing the equations down, trying to figure out, is this valid? What is the point they're trying to make and try to interpret that?
but more importantly, is it valuable?
Yes. Yes.
Is it worth the time that you spent to puzzle those things out?
Yeah. I mean, quant financing is one of those areas where a lot of people publish to publish.
Yeah.
I've read a lot of textbooks, and to your point, it's like you read it and you go, okay, so in a perfect world, this is how the Black-Scholes would get priced. And, here's 30 other textbooks to have the same equation and the same notions, but they never get into the details of the application of, this isn't going to work in the real world, or you're not going to be able to program this in, or some issue.
I had an argument with another economist once. We were talking about the fact that I was using an equilibrium approach to value assets in Lindner's CAPM. He says he much prefers an arbitrage approach. And I said, oh, really? And he says, yes. Everyone knows arbitrage is superior to an equilibrium approach. Everyone believes that. And I said, you're talking about the continuous time trading with no costs, right? And infinitely divisible assets, long and short. Yeah, that's what you mean by arbitrage?
Yeah.
No arbitrage according to a model that makes these assumptions. This seems to be a lot less believable than an equilibrium model where people are trying to benchmark to other assets and figure out a relative valuation. Both have errors associated with them,
Yeah.
right? And the arbitrage errors could be as great or greater than the equilibrium errors in pricing.
Yeah. It's hard to digest these too. And you get into these discussions because there's obviously like assumptions that need to be baked in. And I think often being in the industry kind of humbles you So I know even like coming out of grad school, it's like, oh, I'm so smart. I've got this figured out.
Yeah.
And then you have a problem someone gives you and you're scratching your head for like a month. Like, I don't even know where to start on this.
But those are the good problems.
They are. They are.
The ones that keep you awake.
Yeah. I've been trying to explain to some of the business people that I work with because they go, oh, you come into work, you sit down, you write your code, you build your model. And I said, guys, most of my working time is, at dinner, in the evenings, in the mornings, in the drives to work. And they go, what do you mean? I said, well, you have this problem. And they go, okay, well, I have to solve it. Like, it's not like, I need to solve it so I get the paycheck. It's like it's bugging me in my head that you have this problem. There is a solution for it
Yeah.
somehow, some way, and I need to come up with that solution. And they look at me like I'm crazy. Like, why do you think about this outside of work? Can't you just sit down and do it? And it's like, for me, it's this process. I need to think about it and work through it. And then I think I'm crazy. And then I write it down on paper and it's like, oh, this makes no sense. And you kind of got to go through that iterative process of figuring out where the issues are and how to solve them.
Yeah. I think my best paper, my most widely cited paper is implied probability distributions for option prices. And
Okay.
that one, I figured that one out on a subway ride from the Upper West Side down to Wall Street. And I wrote it up the same day and submitted it, got published. It's like other papers I spent a year on that never got published. So
Yeah. Yeah. I have one of my big breakthroughs for my current role is I woke up, I think it was like 2:30 in the morning. And I woke up and I was just like, I had the thought and I knew exactly what it was. And of course, being me, I've got a whiteboard in my room. So I hop out of bed. My wife's like, what are you doing? And I'm like, I've got an idea. I've got an idea. And so I'm like, writing it out and drawing the pictures and everything so I don't forget it by the time I wake up in the morning.
that's fantastic. I think I should start doing that as well.
It's always those problems that bug me though. It's like for some reason I think about them and I think about them. And then I think when I'm sleeping, it's like subconscious, like my brain's still trying to solve the issue.
Yeah.
And sometimes it's just like it sparks and it's like, I've got it. I think I've got the solution to this.
That's a great moment.
Yeah.
So sometimes you wake up and your whiteboard is full of gobbledygook from the
Yes.
night before.
Yep. I've had that happen before. I'm like, I don't know what I was thinking. Oh, so you want to talk a little bit about you're working on a new venture here. So you're still teaching NYU as we're talking about. And then you guys, I saw you started posting, Wall Street Scholar started coming up. And so of course I'm looking at, I go to the website and I'm looking through the list of people. So you posted it, I saw you, and then I'm looking through the people like, oh, I recognize other individuals on that list. Do you want to talk about, what did Wall Street Scholars start? How did it start? How did you guys get going with it? What is kind of the goals of it?
Yeah. Well, of course, I'd love to talk about that subject. We're very excited about this. We just launched it a few months ago. We have some top scholars who've joined us, like Quant, Raphael Duadi, others. Please check the website. I don't want to, well, I could give everyone's name also. Robert Banani, Nadia Babai, Stephen Figluski, and Amina Busla. And these are people who have gotten together with the idea that, as individuals, we as academic consultants don't really play a bigger role as we could play in financial advisory.
Okay.
For someone to hire an academic, they have to really have a really clear idea of what it is they want. They can define the problem to some degree. Of course, some academics are better than others at defining those problems for their clients and so on. But in general, their first call is going to be to a different type of consulting firm than an academic.
Okay. Yeah.
So we thought, okay, why don't we create a group of academics that's recognizably first class, right? So that if you, as a senior manager at a company, had a problem that was, elusive for the usual consulting firms, the ones who send the well-polished partners to sell the projects, and then you get the newbies to execute on the projects
Yeah.
and learn your business and get paid to do so. The sort of bottom-heavy model that populates many consulting business plans. Ours is the opposite. We're a top-heavy model. So we have all our talent at the top. We're all part-time, because we have day jobs.
Yeah.
But most universities allow academics like a day a week to consult, and so we're taking advantage of that and saying, hey, if you want to have a different type of advisor, look to our team of academic consultants. And if we don't have someone who can address your problem, we can easily find someone as well. We can scale up very easily. If we need to find, students to work on projects and to do work which they frankly can do better than I can. Some of the scholars are better than I am at like machine learning and data management and LLMs and all these things that we do, of course. But the point is that we can deliver scale as well. So the idea is to have a top-heavy, scalable, high value added consulting service.
Okay.
Okay, so we're not going after, the kind of jobs that are mechanical,
Yeah.
where you want to just hire a bunch of consultants to come in and run standard valuation models on all your books. I mean, we're not going to do that. But we're going to do these kinds of strategic projects that require that kind of a perspective.
Is one reason that you guys are doing this, is there a way to get around the NADAs or the NDAs? I'm stuck in pricing models with
Oh,
not a values. Um, for non-disclosure agreements, I know one of the issues, like I've wanted to work with academics or even like the students at schools, and I think one of the struggles we always faced was how do you hire them? How do you make the solution? But then how do you also not get that solution necessarily published?
hmm. So, I've been a consultant since, I don't know, 2000 and no, 1999. So like when I left Deutsche Bank, or Deutsche Bank left me, I should say. We became a group of 25 consultants called Risk Capital, which actually won a couple Euromoney awards. It was a really great time and great time to be in the energy risk and valuation markets. But we always had NDAs with our clients.
Okay.
The problem we had was a little bit different, which was that a lot of the stuff we were bringing to the table was our intellectual property already, and some
Okay.
of the stuff that would be created with their data or their insights was rightfully their intellectual property. So in every contract we wrote, we'd have some kind of annex which says, made very clear what intellectual property belongs to us.
Okay.
So we could avoid that problem and then otherwise have an unrestricted NDA. I think one exception was the banks. The banks at the time had like a 3-year limit on the term of these contracts. And so we had to obviously apply any constraints to that, but that was our general policy.
Okay.
And so it's the same thing here. I mean, of course, all of our scholars bring, legacy of intellectual property to the table.
Mhm.
And luckily, most of that's documented. We have papers, we have presentations that would be predating any project, and we can point to those and say, this is our claim to our IP.
That's good. I know that's it's a hard thing because you have the two halves. And
Yeah,
obviously, if you guys didn't have some sort of, greater insight and depth, why hire? Like,
exactly. Yeah.
so in your is breadth, I liked the diversity you guys had. So I went through and I looked at the different candidates and I pulled up some of the profiles. I was surprised to even see a validation, um, perspective on that because finance is such a wide area. It's not as like I think a lot of people assume it's like one narrow thing, but as you start getting into the depths of different businesses and practices and regulatory differences between firms and problems, it's nice to see that you guys are trying to cover as much of the market as possible, and you could bring in, somebody else to kind of help cover those.
Yeah. And so that's the idea is we can put together different teams for different projects and also be sensitive to the availability of any of these academics at any time.
Okay.
So I think that's the idea is to be able to give like innovative perspectives and solutions, especially now with AI going crazy. 3 of our guys are AI experts, you
Hmm.
know, and of course there's some standard applications where we don't try to compete, but in terms of the specialized applications, there's lots of things that we can do. Specializing AI applications to finance, for example.
Yeah.
You know,
Yeah. I think the regulatory framework too makes it a lot more challenging where I've had people in tech and it's like, they just throw mud on the wall and if it sticks, it sticks. And we don't really care. There's no consequences in the tech world. Whereas in the financial realm, regardless if you're using it internally, you still have risks associated with that. And then more specifically, if you're using it like client facing or customer facing, your risks grow significantly on the damages that could occur from using such tools.
right. So Yeah, I think, there's so many possibilities in finance, and I think that all these startup AI firms are looking to solve the biggest problems in the world, and rightly so, you know. But imagine what we could do if we focused our efforts.
Hmm.
Maybe not a blockchain for the world, but a kind of a private blockchain of our own, right? That has some clues.
Yeah, I think finance is going to solve a lot of these. I think before tech. I made a video on it and people are up in arms over it. But I think having that sense of risk management that's kind of baked into the industry in itself, it's like we want to explore and we test, but we still put some sort of logical limits around the possibilities. And so I've seen a lot of interesting work. I was talking to a few of the large banks, and they're using it internally as they're using an LLM as a recommender system of getting solutions and answers quickly. So instead of having to send out, the mass email of, hey, can somebody update me on this project? There's, 20 people on this from all these different departments. It was like they're starting to work on this where they store a lot of this internally. And I don't know how they're doing risk controls around, who has access to what information, but they're trying to use that as a way to kind of limit the number of meetings, the number of emails, and kind of get the right information to the right people.
Yeah.
But I thought that was a really unique perspective of it instead of, yeah, pie in the sky. How do I convince people to give me money for wealth management and use AI to do it and no one's working and
Well, even in my classwork and research, I'm finding, at first I was suspicious about ChatGPT and use it to write poems and stuff like this. But now I say, can you give me an equation for, the present value of a Fibonacci sequence, for example, and it comes up with the right answer or the wrong answer, but at least you have something that gives you a few ideas as to how to solve the problem.
yeah, I'm still very, very hesitant to use any of it. I've yeah. I mean, I know you're of classes, right? You have students that are using it probably.
Yeah.
And for
But
me,
it's clear. It's clear when you read the reports.
yes. I think my concern, especially with students, is that since you often don't have enough grounding, it's a lot harder to differentiate, is this the correct
Yeah, exactly.
solution?
I think I have a perfect AI tool, which would be to take results from ChatGPT and translate them, rewrite them in a style that would be consistent with, who you are, where you're from, what your work experience is, and your background, so that you could actually really, have a spoof, so a ChatGPT answer customized to the person who was going to use that as a paper or you know,
That would
just
be that
whatever.
would be interesting. Like take your work, especially as like an academic, right, or a professional, take all your work, compile it all, and then run it through as like a layer on top of it, and
Yeah,
then help kind of generate, I guess, yeah.
we'll call it the anti-chat GPT.
So with your Wall Street scholars here, you guys are, you mentioned you're bringing students to help with this, or how is that working with kind of the process?
So if we have a project that's labor intensive, and the students we have among us, we have hundreds of students available. NYU alone has 150 financial engineering students a year. You're looking for internships and so on. So there's no shortage of students. Um, so we can find that. But like I said, we're not focusing on those kind of high volume projects, but we need specialized skills that can be done in a more efficient way. We can actually do that. I think one of the things that differentiates us is that we're looking to really focus on applied problems. We're not academics, right? We're not fully practitioners either. We're somewhere in that space in between,
Yeah.
right? And so what you'll find in common with all these people on the website is that there's certainly a wide range of skills, mathematical skills and so on, economic skills, but also practitioner skills. That we recognize that, the what makes someone a Wall Street scholar, it's not that they write theoretical papers that somehow have a claim to cover some Wall Street relevant topic, but that we actually write stuff or work on problems that are real problems on Wall Street.
Okay.
So this is kind of another theme that I wanted to stress with you is that, we're not you wouldn't get us, I don't think, hire us to write a white paper, about some theoretical mathematical concept.
Yeah.
You
Yeah.
know?
You guys are more interested in actually solving real world problems, helping
Yeah.
businesses get solutions.
And of course we were write white papers if it's the first stage in a problem solution, but not as an end in itself, you know?
Yeah.
So that's very important to us. And the other thing is that we realized if you talk about scholars, and if we only focus on, established people in the profession, we're missing something. And we
Hmm.
have to think about the future of the profession as well. And all these young scholars, what can we do to help them? And I know that you in your work here, you've been doing providing a lot of help to young scholars and young professionals,
Yeah.
So I congratulate you for that. We're joining your bandwagon in a way here by trying to, offer tools and support to young people in the profession as well.
Okay.
For example, you may have seen on the website we're sponsoring a contest.
Hmm.
We're focusing on applied AI papers in finance, thinking that would be a good way to focus people and inviting anyone to submit, papers. And we have a couple prizes. I mean, it's not $1 million or anything, but at least there's something to provide recognition to those who have the best papers as judged by our scholars.
Yeah. And I think more importantly, so if anyone that's a student that's listening or academic, I think more importantly is the resume.
Hmm.
So I'm so tired of looking at resumes and they have like the project section and it's like Markowitz portfolio optimization. And
Yeah,
it's,
right.
I did Markowitz optimization and it's like,
Yeah,
you can
okay.
copy and paste this from the internet. But I think this would be a great opportunity for the students to really say, okay, you know, there's some prize money and that's good, that's short term. But how do I come up with an interesting problem to solve? And I write a paper and I submit it for this. But more importantly, you can put it on the resume. And then when you go to do an actual interview, people can ask, more detailed questions around that project. I find a lot of the students, there's kind of a black and white field of students who went through the masters, could be, big name, top schools, and it's like they went through the motions. There was no thought process. It's, I did homework assignment, I read the chapters, I went to class, I have the degree, I'm done. And then you have the students that did the work and stuff as well, but they were the students that were like, but why? Like, why is this working? Or why does this not work? Or, our teacher said this in class, but it makes no sense. And they're out doing those interesting projects, even if just self-learning, of trying to really grasp the issues with it. And I think when you look at hiring, I can tell you from looking at class, I remember going to grad school, now looking back and thinking the students that fit that group, they all got placed really quick. The other students that were kind of like, oh, I got great grades, but I didn't do anything of value. I didn't think through the process. They got, interviews, but they just never passed them because that kind of differentiating factor of, are you really thinking about these problems? And kind of as we're talking about, right? The industry is interesting because no one's going to come to you and say, hey, fit CAPM to this and price this for me because they can easily do that in an hour, 2 hours. They don't need a team of people and researchers and quants and interesting minds to kind of solve these problems.
Yeah, you're absolutely right. I mean, there's some level at which they want those people, right? But those jobs can be staffed by undergraduates and MBAs.
Yeah.
If you're going to call yourself a financial engineer, I tell my students, you have to be prepared to solve problems in finance. And yes, you know the theory of finance, but that's not the end because there's something about your project that doesn't apply, right?
Yeah.
That causes that theory to have less value, and you have to figure out a workaround.
Yeah.
Like an engineer with a bridge, and now besides wind patterns, you have to worry about hail and rain and you know uh, whatever. It's an engineer solves problems, right? So how can you claim to be an engineer unless you can go into a reasonable financial situation that no one has really thought of a problem for, and they're hiring you to solve that problem? Now, maybe your first job, it's not as grand as all of that, but certainly by the time you're three years in, if you're not solving client problems, you're not solving the firm's problems. What's your value?
Yeah.
You need to value a deal. I tell students, okay, you can take a pricing model off the shelf to value a swap option or something like this, and you have a model off the shelf. Okay, you can build that. You can build a customized model, right? So spend time. They do the academic approach to get a closed form solution. Got it. And then I say, well, here's a real Wall Street situation. Is on day one, they tell you the client's going to do this deal, and it's got to close by the end of the week. And you spend 4 days, you get the model working, and you've been working, 15 hours a day to get this thing up and running and tested and vetted. And finally, on the fifth day, they say, oh, by the way, the client wants to change this feature.
Yes. Yep. I've been there many times.
Yeah. Oh, there's credit risk in this product? You know, I didn't know because I didn't price that in. And how am I going to do it because it's so complicated? And so you screw yourself. Forgive this is going to be a recorded conversation. But the point is you have to figure out in advance, you know, your own operational risk, right? Your own tolerance and your ability to adjust what happens when, as inevitably will happen, the deal terms get changed.
Hmm.
So it's not just teaching students formulas and stuff like this. It's about how do you approach valuation in a way that you know that in practice, right? The problem is going to be moving along and
Yeah.
changing direction. The problem itself. So you got to be able to move along with it. So this is why, you know, I focus on like school or skills more like simulation,
Hmm.
which are, maybe they in the old days they used to be slower, but now they're competitive with closed forms. And when you consider, you know, the practical benefit of it, you know, it's even more so,
Yeah.
you know. And if you have a need for speed, you can just, you know, you hook up 100 processors in you know Amazon and run in parallel, get as much speed as you want, right? I mean,
Yeah.
so there's no time limit on simulation anymore. And so it's a big part of my valuation class to say it's not just the approach to understanding how to price risk and so on, but how to build models that
Yeah.
are robust to the environment that you're building them in.
I think that for me has been the hardest thing to express on YouTube is, everyone goes through and they say, yeah, yeah, Dimitri, I've got the equations, I've done this stuff. And I'm like, I have really unique, interesting solutions. Like the business will say, hey, like
Great.
it's great you can do this, but I want it to do these other 15 things. Can you make this happen? And I'd love to make a YouTube video. I'm like, all right, this is the standard problem. This is the ridiculousness they're going to require. And, it's valid. I get what you're using it for. It makes complete sense. You want it to do all these fancy tricks and everything, and it has to meet all these requirements. But it's always hard to convey that on YouTube because I can't go to my employer and say, all right, I'm going to take your data, I'm going to take your problem, and I'm going to make a presentation explaining this on YouTube. But at the same token, I think it's hard to explain to students like the equations you learn are good, but often the skills, the analytical skills of looking at problems, coming up with unique solutions, using tools that you didn't necessarily apply to that problem in class. I think that's the hard part. And
Yeah.
the other piece too is companies, I think, struggle on this from a retention standpoint. Went through a few companies, I've talked to them, and they said, Dimitri, I can't retain quants. We keep hiring them, and I'm going to, these other big firms and pulling talent in, or I'm going to these universities that are top notch, and we have them, and they last like a year, and they're just gone. And so then I start asking them, like, what is the problem you're solving? And it's some mundane, like, an MBA job where it's like, these are the steps, these are the process, this is the theory. And I'm like, you got to get them something interesting. Like, you can keep paying the quants more and more, but at some point they're going to realize, like, I'm bored. There's no interesting problem to solve here. And they move on. And the response from the businesses are always like, they're like puzzled, like, really? If you gave them something that's more complex, more interesting, they would stay. And I'm like, you can pay quants less often as long as you have a really interesting problem because they're, like we were talking about earlier, they're tied in. They have to solve it, not for the dollar, but they have to solve it mentally because now it's this challenge that needs to be completed.
You know, we talked about Fisher Black a while ago, and it reminds me of a time when he suggested that academics shouldn't be paid.
Okay.
And the logic was if they, you know, if they're really great academics, they're motivated by the problems, not by the pay. You know? Of course, that was a bit controversial at the time, and maybe one of the reasons he wasn't as popular as he could have been. But
I could see that.
well, the alternative for the quants is they can always get promoted if if they don't give up.
Yeah. So when you guys have these papers from the students, they're going to be submitted. Are you guys going to publish any of them? Like make them?
Yes, we're planning. You know, we want to grow Wall Street Scholars into a publications platform.
Okay.
We're trying to get, you know, early stage publications so that there'll be a demand for people to read them because they'll be innovative. There won't be much of a time delay in getting them up on the website. We're going to allow people to comment on the papers when they are posted. In addition, we will provide a written referee report to go with each paper. So if you want to determine if a paper is of quality or not, you can, without reading the whole paper, you could just see the referee's report or see if it's, you know, relevant to you.
Okay.
Obviously, no referee report is perfect, but the point is you can get a fast read on whether the paper is relevant and whether it's good. So we think that these kind of features, we'll publish those feature papers. We'll feature the award winners, of course, and then we'll offer online seminars as well, so they can present their paper at a seminar, and we'll record it for anyone who wants to watch it asynchronously. But over time, build a library of these kinds of, hopefully, many many papers, and some of those will be cutting edge and very valuable.
Do you think this will turn into like a hiring process? Because I could see like,
I'm hoping that, yeah, we can, that someone like a Citibank could come to a website like this and say, hey, let's look at the top 10 Wall Street scholars, when we're looking for people with quantitative skills in uh, finance or financial engineering,
okay,
that they have a chance as students to showcase their work and to, to get themselves recognized and hopefully ranked favorably in the eyes of potential employers.
yeah, I could see it as an easy hiring tool, especially if I go in and I'm like, all right, this is what I do. I'm looking at the papers, and these are like the candidates that have interesting work, and then trying to find out like what are they doing, where are they working. I mean, even using it as a poaching tool.
Yeah.
But yeah, it's great you guys are working on this. I'm excited to see that. I knew originally it was, I saw Wall Street Scholars, and it was all of you guys as kind of the senior scholars of it. And then you reached out and you're like, well, we're doing student work too. And I was like, this is great. This is giving back to the community. This is building the talent. And then I think kind of the longer term piece is, you're going to be layering in talent as it matures across time anyways. Instead of, just having a kind of two-tier system, you'll start to see kind of that expertise as students rise and build careers and hopefully can give back to this.
Yeah. I think it was a life cycle thing.
Yeah.
At this stage in my life, right, I've seen my students go through these cycles. It's so rewarding that you get someone at a, I teach some high school and college programs, in China every summer. And I stay in touch with some of the students, and unbelievable, and some of them are like now at the point where they're VPs, and one is a managing director somewhere, and it's just heartwarming, right, to see what can happen,
Yeah. Yeah.
you
It's
know?
amazing. Even with my YouTube channel, I don't get a lot of feedback because I mean, you've got millions of views. I've got almost 50,000 viewers. But then somebody will write me that email and they'll say, hey, Dimitri, I wanted to, thank you. I went through the process, followed some advice, got into grad school. Now I've got my first job working at, this big firm. And then it's exciting now because I email them and I'm like, hey, thanks for the feedback. Please do stay in touch. And it is rewarding to see that it's like, oh, they went on to get promoted and they went to another firm and now
Yeah.
they're running teams. And even some of the people that I started YouTube, I think like a year into my first job. So a lot of these guys are even at the beginning, they're at my level. And it's great to see people out doing, unique jobs and tasks and kind of that rewarding process here.
Yeah, I mean, and that certainly it speaks to my, I guess, professor side there. I really like I really like to see their development. I
Yeah.
like to see them have the aha moments.
Yeah,
And
definitely.
when they get that spark of a problem that, no one else has solved, and they get a chance to, you know, to get a stab at it,
Yeah.
you know?
Yeah, it's one of those things I think it's hard to explain, right? Until you've solved something and you really get the excitement of like solving that problem.
And say, This is mine. This is,
Yeah.
So people say research, that sounds like such a boring career. I say, how can you say that? Finding something that no one else has found. I mean, you spend your whole graduate career, you're thinking every week that you found something new that no one else has found. And you go to, Google Scholar, you find out that there's 3,000 papers on this subject already. So you probably aren't unique, but eventually you get to the point where there's only three other papers, and then there's one other paper, and then finally you get to the stage where there's something you discovered that no one else has.
Yeah.
And wow, isn't that a great day?
And I think industry's been great for that in the sense that my biggest concern when I was, much younger, thinking, should I get a master? Should I get a PhD? And I was like, if I went purely into academia, that concern was always there of what if I spend an entire career looking for an idea and then I retire and then you never have a groundbreaking paper, right? Maybe you published a couple here and there, but it just never full circled. Whereas in the industry, it was always exciting. So I'm like, to your point, right? This is the problem. It has to have some solution. There is no option for like,
Yeah.
we sit on this for a lifetime and come up with an idea for this.
What's one of the reasons I left academics is because I did a calculation one day. Um, there were maybe 6 academics reading my work at the time, as far as I could see. And that was probably an optimistic account. One of my PhD students went to work at JP Morgan instead of going the academic route. And shortly thereafter, fixed me up with a job offer there. Of course, I had to interview and so on, but I got the good fortune of getting the JP Morgan job.
Yeah.
And one of the first things out of the gate was, they wanted me to elevate, kind of this idea of risk management and solutions to client problems. So I wrote a column in Risk Magazine for 5 years. And all of a sudden I had 5,000 readers.
Yeah. It's
Yeah.
amazing how it grows.
So from 6 to 5,000 seemed like a pretty good trade. Plus, I think the pay was 3 times as much. It wasn't really that much of a decision, to be honest. But now you have 50,000 viewers, so I can't compete with that.
I'm slowly getting there. I wish I could spend more time doing technical work, like the technical videos. But oddly enough, there's this trade-off of when you do, I guess, in an academic realm, right? You do these really technical papers, these technical ideas. I get views similar to this, right? You get 100 views. 100 people watch the video, nothing great. I'll make a ridiculous video on, I don't know, why finance is wrong or something, or why AI is going to take over the world. And of course, the title will be somewhat misleading. It's not really on taking over the world or anything. And then you'll get, 10,000 views, and it's like trying to weigh the intellectual rigor and the self-worth of making the video versus, it would be nice to get that 100,000 mark of subscribers so YouTube will finally give me the plaque and say, you're a real YouTuber, you've made it to
Yeah.
that level.
Can you get on YouTube without a misleading title though?
Not really. I'm using AI now to kind of make shorts, which are like little reels of our interviews, right? Because I'll make this interview, for example, and it's David Shimko, valuation experts, discusses with Wall Street scholars, whatever. And we go through it, and then it'll get some views, but everyone goes, "Oh, this is like an hour-long podcast. I don't want to spend
Yeah.
that much time." You create the shorts. I use AI to do it now, and it has like the titles are a little stretched, but you'll have one short, which is like a 30 to 60-second clip of us. It'll get more views than the entire the 1 hour podcast.
It's not a bad outcome, right? In equilibrium.
Yeah, yeah.
Who has hours to spend in front of their laptop? I don't know. Or their
Yeah.
iPhone.
I don't know. I do it when I drive.
Ah,
I put them on. It's like I don't even care watching the video part. I just want to listen to the
oh,
conversations.
thank God. I'm glad you're watching the road.
Yeah. I've seen people watching the phones though, which scares me. But the other point too is I see a lot of people not taking advantage of these long form content.
Yeah.
But I think often you get a lot more context from these. You start to understand like the thought process and the ideas. And more importantly, I think you understand the industry a little bit better. You start to see like how, how David Shimko thinks, how Peter Carr thinks. You start to see like there's this process that's going through the way you think, the way you talk, and kind of draw these out. I wish more people would enjoy the longer form content and really absorb the material versus,
Yeah.
tell me the answer.
There's so much competition these days, for those eyeballs in the old language.
Yeah.
But it's really tough. How do you convince your audience that it's worth 60 minutes of their time to watch a video?
Yeah. It's tough. So to wrap this podcast up here, do you want to talk about any new research projects that you're working on or papers?
Check my list of possible topics here. But there's one interesting project we're working on the consulting side, if you'd like to discuss it.
Yeah.
This is the industry paper I mentioned to you, which has to do with life insurance. Does that seem relevant and useful to you?
Oh yeah. Oh yeah.
So basically, we've come across this fellow called Elon Moaz,
Okay.
who's a whistleblower for the life insurance industry, and he's published a book which I got a copy of, and I thought, this is really quite fascinating. That he looks at life insurance contracts from the point of view of the suitability, right, for individuals. And this is suitability is obviously a financial concept more than a life insurance contract, but it should arguably be applied to life insurance as well.
Hmm.
Are these products suitable for individuals? So the project we're working on now is to be able to evaluate uh, IUL, which is an indexed universal life policy, and also VUL, which is a variable universal life. I'm going to shorten the titles to make them easier to understand. One is linked to money markets, the first one, and the second one is linked to equities.
Okay.
So in both of these products, what you do is you take your investment, either goes into money markets or equities, and instead of paying cash for your insurance over your lifetime, what you do is you pay into this fund, and the fund should grow either at a money market rate or a market rate, whatever you chose to do. And the proceeds of that investment should be used to fund the cost of insurance going forward. So if you look at across the board, all the people that have gone into these types of contracts, maybe starting 20 years or more ago, right, earlier in their working careers, and they've gone through some periods of very low interest rates, as you know,
Hmm.
some volatile markets, as you know, and a lot of cases, these policies are going to end up in a situation, right, where there won't be enough investment return to pay life insurance premiums past age 85.
Okay.
So if you're unhealthy, you're going to die young, maybe you don't care. But the people who are worried about living past 85 will find that in most cases, their policies will lapse.
Okay.
Now, the insurance companies don't have a problem with this. It seems like a fair bet to them. But to the individuals who expected that they were buying permanent life insurance, this is problematic, right? They're expecting a death benefit at some time to pass on to their heirs. And they're
Hmm.
going to lose it because the investment performance of their money market or stock fund wasn't enough to pay their insurance premiums. Now, you could respond, well, they can just come in and, you know, they can put their money in the 80s to keep the policy alive. But the problem with that is that people at that point are retired, they're often on fixed income, and the cost of keeping that insurance policy alive might be 4 or 5 times what your Social Security and pension are combined.
Yeah.
You know? And so in these cases, what's going to happen? You have the option to keep the policy alive by putting more cash into it, but it's a decision that almost everyone decides at that point. It's their option they don't exercise. It's too expensive to exercise.
Do you lose everything in that account?
So if there is cash value, you get it back. But what causes the policy to lapse is there's no more cash value left.
Okay. So essentially their expenses for insurance are climbing too high when you're older, and then also your income's declining, so you don't have the cash to put in to cover it, and then your investments just haven't kept up with the cost of your healthcare.
Yeah. Now hopefully you have other investments, and that's going to, give something to your heirs and so on. But the point is that this insurance contract is never going to pay you anything, right?
Yeah.
So what we thought is, what can we do about this? I mean, the insurance companies, in a way, they're offering a product that is legitimate, right? To
Hmm.
say, yeah, of course you can have a policy that's funded by a risky asset, and if the risky asset fails, you should expect it to lapse reasonably. I mean, that's a contract which gives you life insurance protection in your young age, but not in your old age, right? If markets don't perform, but that's a risk that people are taking. It's fully disclosed at the beginning. The insurance company has technically done nothing wrong, you could argue, right? However, the way insurance policies are sold, they are often, there's some kind of illustration attached to them called an in-force illustration, which shows that if you make assumptions about the money market rate or the stock market returns, you can show cases where, yeah, you're going to have life insurance up to age 100, which a lot of people would be happy with.
Yeah.
Maybe not some, a lot more would be happy having insurance to age 100 rather than just to age 85. So great. We can say, all right, this is the kind of policy that was sold to people based on the expectation that it would be, if not a permanent life insurance, something very close to it.
Hmm.
So there's something going on here, right? Causing people to buy these insurance policies that have a high risk of lapsation. So we thought, okay, rather than trying to go after insurance companies offer services like consulting or valuation services, rather than going after the insurance brokerages, which is now a kind of fragmented industry, separated from the actual insurance providers, let's go to the corporations who have offered these plans as options for their employees
Okay.
and say, we will as Wall Street scholars, right? We're going to put our collective financial expertise to work, not insurance valuation techniques, but financial valuation techniques to say, how do these policies compare in value?
Hmm.
If you think of it as a very complex derivative contract,
Yeah.
there's some options that are included. Some contracts are better than others. They have different kinds of guarantees, but guarantees are costly. They have different kinds of management fees, and management fees are also costly. So it's hard to say, especially for a typical consumer, how to evaluate the value of these contracts. So what we do is we compare it to a benchmark strategy, which is made popular on the internet. That you, instead of buying one of these policies, you would buy term life insurance, where it's going to end after 20 or 30 years or whatever number you choose.
Hmm.
You know the costs, and then and you go into this with wide open eyes. The cost is much lower to get in, so you take the difference in cost and then invest that difference,
Okay.
right, over
Yeah.
time to create for yourself a death benefit through your investment,
Yeah.
right? Not pay the 2% management fee, right? And pay the cost of the much cheaper term life insurance compared to these, you know, indexed universal life or variable universal life policies. So that's our benchmark. And they say, okay, we're going to value those two contracts relative to your benchmark.
Hmm.
The benefit of doing that is for every individual you simulate, the death event, right, would happen in all three cases at the same time.
Yeah.
So you eliminate a major risk, right, from a benchmarking perspective, and you can get a very precise measure of the relative value of the IUL and the VUL relative to, buying term insurance and investing the difference, which we call BTID.
Okay.
So right now we're in the early stages of marketing this to companies to say, hey, the Wall Street scholars would love to review your life insurance plans, in particular these individuals who are affected by whole life, universal life policies, and to be able to, evaluate these policies, calculate the probability of lapsation,
Mhm.
and suggest, changes in policies where warranted.
Yeah. It's a very financial approach.
Yeah.
In the back of my head, I start wondering now when I look at insurance policies, I'm like, can I just self-insure to a
You
point? Because you start to think about to the valuation piece, right? Obviously, if you have an event, so like is life insurance, if you die young, okay, it's like you want to have the lump sum there. But at the same token, I start to think about the long-term perspective of maybe I should invest something longer term to cover that position. And I don't necessarily need to pay a premium to pay a company to offer that value when you could just invest on your own, avoid the fees, and kind of self-insure in that longer period.
Yeah. But there's one big benefit to the term life insurance, which is that the insurance part, well, I should say two benefits. The first part is the death benefit when it comes is not taxed,
Okay.
right? So you want that kind of tax benefit associated with that.
Hmm.
The second point I'll make is if you're in your 30s and 40s, right? Maybe you're married, you have a family, you're concerned about the loss of income and what effect it will have on that family. So it makes sense in that age range to have some life insurance,
Hmm.
right? But as you get into your 60s, 70s, and 80s, it makes less sense.
Yeah.
Unless you have this true bequest motive or something like this that you're trying to satisfy from your own personal perspective. By that time, if you're a professional person, certainly you've built your assets, and by having cheaper insurance along the way, you've been able to take that extra money and invest that, so worse off doing that.
Right.
So this is exactly what a lot of analysts are recommending, is to yes, buy term life insurance appropriate for your circumstances. But these complex policies, have a lot of features which are difficult to value and to understand.
Hmm.
Invest the difference in the savings of cost and produce a nest egg for yourself that is yours It is your own.
I think that's good advice. I have employees will often ask me, new hires, and they'll get like a life insurance policy, which is, given by the company. And then you can add on these extra features. And they ask me, should I add these on? And I'm like, I don't know what to tell you. You know,
Yeah, the guaranteed minimum death benefit's going to cost you 44 basis points. Is it worth it or not? I mean, how do you know?
Yeah. Yeah. It's a little more complicated than, yeah. Yeah. Let me write this out real quick.
Oh, yeah, I'm a little rusty on my stochastic differential equations. Hmm, what's that really worth?
Yeah. Yeah. And I think it's unreasonable to expect an average person to do it.
Yeah.
So that'll be interesting to see how those come out.
So that's our goal, and hopefully some corporations will some enlightened corporations will see that this is to their benefit to solve their long-term problems for their employees who are affected by it.
Yeah. Yeah. It's an interesting project.
I think so, and I'm learning more and more about insurance. Believe it or not, I passed 3 actuarial exams when I was trying to get my first job, which was an actuary, a junior actuary in a company. But I got out of there as quickly as I could. Back then, we were using spreadsheets. They were actually spreadsheets. They were
Uh-huh.
big paper sheets with squares on them.
Yeah.
So not like Excel where they automatically recalculate. You had to like recalculate all the cells yourself.
Oh, wow. That'd be a lot of tedious work.
Yeah. And then we had APL, I think was our programming language, for the gosh, those were the days.
Oh, yeah. Yeah. I had a student ask me about that. Quantitative finance masters, did some actuarial exams, went into the field, and he came back. He's like, we're using Excel for stuff. I wanted to build out, these new complex models, and I wanted to reinvent the wheel. And they've just got curves. Like they just use the same curve over and over. And I was like, oh, I can't speak too much to it, but it sounds about like insurance.
Yeah. Hey, if it works, milk it.
Yeah. Yeah. Well, David, it was great having you on. I really appreciate you coming on. Again, just to chat about, Wall Street Scholars, what you're working on, teaching, and some of these interesting projects to hopefully give, I guess, students and practitioners a different perspective of what you could be doing kind of throughout your career.
Well, I really appreciate it, and it's a pleasure as always. So thank you so much for inviting me.